Welcome back, everybody. Let me just double check, make sure we're recording here. Okay. So welcome back. Today we're going to be covering Chapter 3. It covers gross income and the inclusions in particular to gross income. So let's start off by just reading through our learning objectives. First one, we want to explain the differences between economic, accounting, and tax concepts of income. Explain the principles used to determine who is taxed on a particular item of income. Determine when a particular item of income is taxable under both the cash and accrual methods of reporting. Apply the rules of Section 61A to determine whether items such as compensation, dividends, alimony, and pensions are taxable. Apologize about that. On this one, obviously, it's not the SEC, it's Section 61 of the Internal Revenue Code, so I apologize. Describe tax planning considerations for inclusions of gross income. Describe compliance and procedural considerations for gross income. Okay, so let's talk a little bit about the accounting concept of income. So obviously income is usually measured when it's realized, okay? So when it's realized, meaning they've performed their obligations, so they've delivered their good or service, and they're entitled to income. So income's usually measured when it's realized. Values are measurable when there is a transaction, meaning that there's a sales price and a basis can be determined during the completed transaction. So I think at this point within their accounting career, they understand the accounting concept of income. So this is pretty much just a review at this point. So once again, realization. This is with the transaction with the second party, and severance and economic interest in property. So now let's talk about the tax concept of income. So there should be an economic benefit, the realization of income, and recognition of income. So that's going to be the tax concept of income. So what are the purposes of income tax concepts? So we have first the administrative convenience of it. Second, going to be the wherewithal to pay. So let's talk a little bit about this first one here, the administrative convenience. So this is going to be the concept of objectivity and administrative convenience to support the tax law selection on income on realization rather than taxing unrealized appreciation. So an example of what administrative convenience is let's say if a piece of land owned by the taxpayer is going to appreciate from $100,000 at the beginning of the tax year to $130,000 at the end of the tax year. So there's not going to be any tax on the $30,000 appreciation until the disposal of the land, right? So that's what we mean here by administrative convenience. So only when you dispose of the asset, if it appreciates in value, are you going to be taxed on that. So that's the administrative convenience. Now with the wherewithal to pay, this is taxing unrealized appreciation would cause cash flow problems for taxpayers. So wherewithal to pay, this is pretty much saying if they were going to tax something just based upon income just being appreciated and not actually realized, then how are they actually going to pay for their taxes? Are there income tax liabilities? Where's the cash going to come from? So, for example, if the $30,000 appreciation base in that property that I just gave an example of, how it appreciated from $100,000 to $130,000 during the year. So let's say in this case it is going to be taxed, right? So they're going to tax that $30,000 appreciation that was not realized at a 25% marginal rate, okay? And that's because of the short-term capital gain, right? Then the taxpayer could be hard-pressed to come up with the $7,500 tax that would be due without the liquidation of the investment. So it pretty much would put a burden on the taxpayer to where they would pretty much have no choice but to liquidate the asset or dispose of the asset to be able to meet their income tax liability. So that's the concept of wherewithal to pay. Okay, next, gross income. So once again, Section 61 of the Internal Revenue Code is going to say that gross income is from whatever source derived, right? So whatever source of income that you derive, that is considered to be gross income. So all accessions to wealth are considered income unless specifically excluded. This includes the fair market value of goods or services received in barter transactions. Okay, next, this is just going to be a little example here of what gross income items are per Section 61 of the Internal Revenue Code. So as we can see here, we have wages, business gross income, gains from property sales, interest, rents, royalties, dividends, alimony through 12/31 of 18, annuities, life insurance proceeds, pensions, COD income, partnership income, IRD, and trust and estate income. So once again, these are gross income items per Section 61 of the Internal Revenue Code. Okay, next, this little 1040 here. Everyone's probably familiar with this form here if they've filed personal income taxes in the past. Pretty much, if you just take some time and look at this, what this is showing is that particular line items of the items we just talked about. These different items, they're just showing you pretty much where they are on here. Like you can see here, qualified dividends. That's this line. This is wages, salaries, tips, interest on 8A. 50 here. That's capital gain. Okay, the 2000 is from rental real estate. So we can get an idea here of pretty much is what this is showing us of just where these items are going to punch into to the Form 1040 for the individual income tax return. So that's all that is. Just a little snapshot to give you a little idea of what it would look like in actual practice. Okay, next, let's talk about the assignment of income, okay? So to whom is income taxable, pretty much? Assignment of income. So an individual providing services is required to recognize income, even though he or she may have assigned the right to receive the income to another. Income from property, meaning interest or rent income, should also be taxed to the owner of the property. So family trusts are not effective to change the incidence of tax on personal service income from the taxpayer earning the income to trust beneficiaries, okay? So that's a little bit on the assignment of income. Next, let's talk about allocating between married couples. So let's see here. So we just see here, common law states, income tax to spouse who earns the income. 41 states are under that common law states, so 41 including common law. Community property states is made up of 9 states, and this is where property acquired after marriage is split 50-50. Okay, so let's just talk a little bit more on that. So income allocation between husband and wife is dependent on state law. Obviously, as we said, it's either going to be common law or community property law. Okay, so the law may be different between community property states. So even though it's a community property state, that could still vary or differ from state to state, even though it's the same type of actual law. So for example, income from separate property for California residents is separate income. Income from separate property for Texas residents is community income. Okay, allocation of income between married persons is important only if separate returns are to be filed. So this is only important if separate returns are going to be filed here. So if you're filing jointly, it's not of a concern. All income of the spouses is included on a joint return. So that's pretty much the basics of the allocation between married couples here. Main thing with this is just know the difference between the common law states and the community property states. Okay, what about the earnings of a minor child? So children are taxed on their own earned income, okay? Even though the minor children are taxed on their own earned income, minors under the age of 18 may be taxable on a certain unearned income at a higher rate, okay? Now this applies to wages of investment income earned by the child, as obviously. And when we're talking about a higher rate, so we're seeing here child's investment income may be subject to the kiddie tax rule. Let's talk a little bit about the cash method of accounting. So income recognition. So we've already discussed the accrual method of accounting, right? So of income recognition. So now let's talk about the opposite, the cash method of accounting, income recognition. Okay, so under the cash method, it's going to be used by most individuals as well as businesses without inventories and businesses with inventories whose average gross receipts for the 3 years prior do not exceed 25 million. And this is with income being reported in the year of actual or constructive receipt, okay? So once again, generally income recognized when actually or constructively received, not when earned. So we mean this is going to be when the money's actually exchanging hands, not when the services or goods are provided. Income can be in the form of cash, property, or services, and non-cash items are going to have to be valued at fair market value for tax purposes. Okay, so now let's expand on the concept of constructive receipt, okay? So once again, constructive receipt is going to be income is made available to the taxpayer who has power to draw upon it, right? No constructive receipt if taxpayer has substantial limitations and power to access income. So what are we talking about here with constructive receipt? Income is made available to a taxpayer who has power to draw upon it. So pretty much what that means is, say they have interest credit to their bank account, right? So say we have access to our bank account, and say over the year we were credited interest for holding the funds in that account, right? So if we have access to that money, then that is constructive receipt, okay? But they don't actually receive it, right? So it's not actually going to be in their hands, even though it is, they have access to it, it's just not in their hands. That's constructive receipt. So let's talk about some exceptions to recognition of income when actually or constructively received, okay? So as you can see here, we have Series AA bonds, farming and ranching income, small taxpayer exception for inventories, okay? So once again, the exceptions exist for certain U.S. savings bonds, crop issuance proceeds, and certain drought-related livestock sales, okay? So these are your exceptions to recognition of income. So the accrual method. Let's talk about this once again. Once again, it says the accrual method, income is recognized when earned or when goods or services have been provided. And in this case, earned is defined as all elements have occurred to fix the right to receive the income, or all events, and amounts can be determined with reasonable accuracy. So once again, accrual method taxpayers generally report income in the year the income is earned. So that's when all events, once again, have occurred to fix the right to income, and the amount of income can be determined with a reasonable accuracy, okay? So there's an exception to that. Prepaid income is recognized when received. So let's think about prepaid income, okay? So let's say we're receiving rent in advance, right? So if we have a building that we rent out to tenants, and we have these tenants pay us rent in advance, well, the IRS says they're going to tax you on that even though you haven't earned it. When you get prepaid income, it's going to be recognized when received, okay? So now there is an exception to the exception. So prepaid income is generally taxable in the year of receipt, right? Exceptions are available in certain prepayments for goods not on hand and prepayments for services not rendered until the following tax year, that is, right? So once again, the exceptions to the exception, as it says here, can defer recognition for prepayment of goods if tax accounting equals financial accounting. Because if you recall from your intermediate course, there's a difference that companies have two different types of books. They have one book for tax purposes and one book for financial reporting purposes. Usually these are two different amounts, which triggers deferred tax assets and deferred tax liabilities. But if you operate on the income tax basis, then that's not going to be an issue. So that would be the case for this right here. Can defer recognition for prepayment of goods if tax accounting equals financial accounting. So if we're operating on the income tax basis of accounting, then that's where the exception to the exception would apply. Can defer recognition if prepaid for services. Once again, must recognize revenue associated with services provided in year 1, and remainder must be recognized in year 2. And this is irrespective of whether or not the services were actually provided. Okay, let's return a little bit to the items of gross income here and expand on them a little bit. So we'll start here with compensation. Compensation is going to be payments for personal services, however titled, are included in gross income. So however these personal services are going to be titled, they're always going to be included in gross income. So types of compensation could include salaries, wages, some fees, commissions, tips, bonuses, and even other specialized forms of compensation. So that's pretty much the long and short of what compensation is. Next, business income. Business income is going to be the total receipts of gross income for service businesses. And then the gross margin, which is the total sales less the cost of goods sold, is going to be the gross income for manufacturing, merchandising, and mining businesses. So it's going to differ between the two types of businesses, whether it's a service in the service industry or if it's in the merchandising, manufacturing, or mining industries. Okay. Let's talk here now about gains from dealings in property, or gains from the sales of property, however you want to word it. So unless one of the several statutory non-recognition provisions are going to apply, gains from dealings in property are going to be included in gross income. Statutory non-recognition provisions include involuntary conversions, like-kind changes, sale of personal residence, and reorganizations. So once again, gains from sales of property, return of capital is not going to be considered income, okay? It's only the gain. Okay, let's next talk about some more about the components of gross income. This one being interest. So once again, obviously, interest is compensation for the use of someone's money. So interest is generally going to be included in gross income. An exclusion for interest on municipal bonds is going to be available as long as these bonds are not going to be issued for certain private activities, issued in excess of the statutory limit, guaranteed by the federal government, or issued for the purpose of acquiring higher interest investments. So in this case, it's known as arbitrage. Okay, let's move on down here to the Series EE savings bonds exception. So interest income from EE savings bond can be excluded if taxpayer meets all the following criteria. Bonds purchased after 1989 by taxpayer 24 or older. Bonds must be purchased and can't be a gift, so they can't be gifted to anybody. You have to actually purchase them yourself. Bond proceeds must be used for tuition and fees. Tuition and fees first reduced by exempt scholarships, veterans benefits, and educational credits. And for married couples that file jointly. So once again, an exclusion is also available for interest for Series EE savings U.S. bonds if the proceeds are used to pay for certain college expenses for the taxpayers or dependents. Now, it is important to note that the exclusion is going to be phased out over certain AGI levels, so we'll get to that down here. So exclusion is going to be completely phased out after taxpayers' marginal adjusted gross income is going to be greater than $94,700 for an individual filing, or $149,550 if you're married filing jointly. If qualified education expenses is going to be less than the Series EE principal plus the interest, then only part of the interest is excluded. And here's going to be the formula to see what part of the EE interest is excluded. So we'll have the qualified educational expenses, and we're going to divide that by the EE interest plus the principal. So once again, this is our formula to be able to find the excluded EE interest right here. Okay. Next, let's talk about some rents and royalties. So gross income is going to include rents and royalties. Refundable security deposits is not going to be included until forfeited. So I'm sure most people at this point has probably had an apartment that they've rented out at some point in their life, and a lot of times when you sign these agreements with your landlords, they'll either make you pay like the first and last month's rent down, or they'll make you pay the first month's rent plus a refundable security deposit. So what they're saying here is security deposits are not income if they are refundable. Losses from these activities may be subject to the passive loss rules. Leasehold improvements in lieu of rent are included in gross income at their fair market value upon completion. Leasehold improvements not in lieu of rent are not going to be included in gross income, okay? Amounts received by the lessor to cancel or modify a lease are included in gross income, okay? And let's point out here, if the fair market value of improvements is not includable, then the lessor has a zero basis in the property. Next, let's talk about dividends. So dividends generally are going to be includable in gross income. So distributions from corporations to shareholders are taxable as dividends to the extent of the shareholders' pro rata share of current or accumulated earnings and profits, okay? Corporate distributions that exceed a shareholder's pro rata share of earnings and profits are going to be treated as a return of capital to the extent of the shareholder's adjusted basis in the subject stock, okay? Corporate distributions exceeding both the E&P and adjusted basis are subject to the gain, usually capital treatment. And qualified dividends are subject to the special tax rates of 0, 15, and 20% under the same rules as net long-term capital gains. So once again, C corporations receiving dividends from other domestic C corporations may claim a dividends received deduction based on how much of the distributing corporation the recipient actually owns. So it's going to, as you can see here, it's going to fall between 50 and 100%. So 50% if the recipient owns less than 20%, 65% if the recipient owns between 20% and 80%, and 100% if the recipient owns more than 80%. And it's important to note that C corporations owning a 10% or more of a foreign subsidiary with only foreign earnings can claim a 100% dividends received deduction. For individuals, dividend rates are capped. Capital gains dividends distributed by mutual funds are going to be reported on the 1099 dividends form and are treated as capital gains and losses on Schedule D. The constructive dividends is a treatment usually asserted by the IRS. So this constructive dividends treatment is going to occur when the employee or the employee shareholders are determined to have either unreasonable compensation or unreported benefits. And the reason why that employees or shareholders here could have unreasonable compensation or unreported benefits is a lot of times these big corporations, and as a way to avoid double taxation, because C corps are subject to double taxation once on its earnings, and then next when they distribute those earnings through the form of dividends. So a way that a lot of these owners or shareholders or employees will try to get money out of the firm to avoid double taxation is to have a really high salary. So that right there will avoid the double taxation of the money. But what the IRS says is they will do constructive dividends if they deem that these people have unreasonable compensation or unreported benefits. So that's what that constructive dividends is. It's the IRS pretty much going after the individual, saying, nope, you should have received dividends instead of had that type of an income. Okay, so if dividend treatment is upheld, then employee shareholder recognizes income and corporation does not obtain a deduction for the value of the deemed dividend. Next, payments incident to divorce. I'm sorry, I'm having a hard time talking today. Payments incident to divorce. So the three types of payments incident to divorce is child support, property settlement, and alimony. So let's look a little bit right here. So let's just see here. Taxpayer of divorce payments, or taxability of divorce payments. So we can see on here on the left column we have the type of payment, and then in the middle we have the payer, and then the payee on the right hand side. So the first type of payment is alimony, and this is going to be an agreement that is post 12/31/18. Okay, so for the payer, it's not deductible on his or her return, and for the payee, the person receiving it, it's not includable in their tax return for income. Now, alimony for an agreement prior to 1/1/19, the payer, it's going to be deductible, and for the payee, the person receiving it, it's not going to be includable. For property settlements, it's not deductible for the payer. The payee, the one receiving it, it's not going to be includable. Next, child support, for the person paying it, it's not deductible. And for the person receiving it, it's not includable. So a little more on alimony. So it must meet all the following criteria: payment in cash, incident to divorce, separation, or written agreement, payments terminate at death of payee, clearly designated as alimony, agreement made between people in separate households. So once again, tax alimony is going to be defined in the code and is included in gross income. Currently, tax alimony must be pursuant to an approved written agreement, as we just established, and this is between the two parties. It's going to be paid in cash or spousal benefit. For the spousal benefit, must terminate at death, and the parties must be living in the separate households. Okay, let's talk a little bit about pensions and annuities. Annuities and pensions are partially included in gross income based on a calculation involving the excess of the expected return over the taxpayer's cost. The exclusion percentage equals the cost divided by the expected return. The exclusion percentage is applied to each recipient in a particular tax year until the cost is fully recovered. Qualified retirement plan annuities use a simplified method to determine the taxable portion of the payments. Under the simplified method, the non-taxable portion of each annuity payment is equal to the taxpayer's after-tax investment divided by anticipated number of payments determined by a statutory table based on the taxpayer's age at the start date. Now, even if the taxpayer outlives the calculated life expectancy, only the actual cost of the annuity is excluded from income. If the taxpayer dies before the entire cost is recovered for being tax-free, any unrecovered cost is deducted on the decedent's final income tax return. Okay, other items in gross income. Let's talk a little bit about life insurance. So the face amount of life insurance proceeds received after death is not going to be taxable. Interest income from life insurance proceeds left with the insurance company is going to be included in the gross income. And then proceeds collected by the insured prior to death, meaning, in other words, the endowment type policy, which exceed premiums, are paid and going to be treated as income. Okay, next let's talk a little bit about discharge of indebtedness. So this is the forgiven amount of a loan, which is going to be considered taxable income. So once again, generally the forgiveness of debt is included in gross income. The exceptions to this general rule exist for bankruptcy and certain other insolvency situations. Now let's talk a little bit about pass-through income. We talked about pass-through income in the first chapter, generally taxable to the recipient. Examples are partnership income, IRD, trust income, and S-Corp distributions. So taxpayers may receive gross income from their interest in their partnerships, S-corporations, estates, trust, and income in respect of a decedent. Any losses from these entities should be evaluated in light of the passive loss rules. Let's talk a little more about some other items in gross income. So prizes, awards, treasure trove, lottery and gambling winnings. So treasure trove is pretty much just being a found treasure, so treasure findings. These are all going to be considered taxable income, okay? Certain achievement awards properly transferred to qualifying charitable organizations will not be included in gross income. Next item, illegal income. These amounts are going to be taxable. So illegal income must be included in gross income. Examples of illegal income include embezzlement proceeds, ransom, bookmaking profits, robbery proceeds, sales of illegal narcotics, and bribes. What a category, huh? Illegal income. Amounts are taxable. So I guess if you pay your tax, as long as you pay your taxes, all is well in the IRS's eyes, as long as you're giving their money. Maybe not in the FBI's or the DEA's eyes, but in according to the IRS, as long as you pay them their money for what you're doing wrong, they're all happy. Unemployment compensation. This creates taxable income. So both government financed and employer financed unemployment compensation are fully included in gross income. Next, calculating taxable Social Security income. So a maximum of 85% of Social Security benefits may be included in gross income for certain taxpayers. Married taxpayers filing jointly whose total of adjusted gross income without FICA plus 50% of FICA plus tax-exempt interest and certain excluded foreign income is less than or equal to $32,000 will pay no tax on their FICA. Single taxpayers whose total of the above described item is less than or equal to $25,000 will pay no tax on his or her FICA. So that's all I'm really going to describe on these charts. So just go ahead and just read through this little flow chart here. This is an important one. I know this is one of the more difficult types of tax issues we'll run across in this book. So this is your first example of one of the more difficult taxable scenarios here. So this is a really important issue of calculating taxable Social Security income. This is actually the question. This is your homework assignment for chapter 3 as well. So slide 32 is of relevance when doing your homework. Just to throw that out there for you. This is your homework assignment, is to describe this process for calculating taxable Social Security income. So once again, this is your flow chart. So just describe that within your homework assignment. Okay, next let's talk about insurance proceeds and court awards. So generally, insurance proceeds and court awards are taxable. This includes insurance proceeds for lost profits. Okay, some of the exceptions. The following amounts are going to be exempt. Proceeds to compensate for destruction of property to the extent of basis, and part of an involuntary conversion under Section 1033 to the extent proceeds are fully reinvested. So what do we mean by involuntary conversion? This is where, say that the government pretty much just bought your land from you, involuntary conversion. So what they're saying is, as long as they won't tax you on the proceeds from the involuntary conversion because they forced you to sell, as long as they'll give you like a period of time, I believe it's a year before it become taxable, but they would have to reinvest it and into an asset of similar use or of similar structure of that sort. So you have to fully reinvest these funds if you do not want to be taxed on it. And once again, this is under Section 1033 of the Internal Revenue Code. Court awards generally are taxable. The exceptions, payments on account of physical injuries or sickness. Those are going to be your two exceptions: the payment on account of physical injuries or sickness. So once again, the potential inclusion of insurance proceeds and court awards in gross income is affected by the reason of the amounts that were received. So, for example, recoveries of lost profits. So whether as insurance proceeds or damages are includable in gross income. Amounts received because of personal injury, once again, or sickness are generally excluded from gross income. Punitive damages awarded on the basis of sickness or physical injury are taxable. So punitive damage are going to be taxable. Now let's talk about recovery of previously deducted amounts, okay? So recovery of previously deducted amounts in a subsequent year may cause income recognition. Okay, so pretty much what's that saying here? So let's look at this. Let's look at this example here. Cindy pays 1,000 in state taxes in her 2017 through wage withholding. Right. She deducts the 1,000 paid on Schedule A of her 2017 federal tax return. When she filed her 2017 tax return in March 2018, she received a $200 refund, which was paid to her in May of 2018. So in this case, Cindy's going to have to recognize that $200 as income in her 2018 federal tax return. So if you withheld too many taxes out of your check the previous year, and you deducted or claimed that on your return from the previous year, and then in the following year you got some of that back, then you have to include that as income, pretty much is what that's saying. Okay, next let's talk about the claim of right. So a taxpayer may receive funds which have disputed ownership. Under the claim of right doctrine, the taxpayer must report the disputed amount as income unless the use of funds is restricted, okay? If the taxpayer is subsequently required to repay the disputed amount, a deduction is available in the year of repayment. An adjustment may be available if the taxpayer's marginal tax rate in the year of inclusion exceeds the taxpayer's marginal tax rate in the year of deduction. So if refunds is more than $3,000, a taxpayer may reduce current tax by actual tax paid on the refund. All right, so that's the end of the slides here, but I want to go ahead and just talk a little more while I have you here. I want to talk now a little bit about tax planning considerations and some compliance and procedural considerations. Okay, so now we've went through the inclusions of gross income and some of the topics under this section. So now let's just go ahead and talk about tax planning considerations. So in terms of shifting income from high bracket taxpayers to low bracket taxpayers can reduce the overall family tax burden. So let's give a little example of this shifting income scenario. So say a taxpayer irrevocably transfers income producing property, for example bonds, to his or her daughter. Income from property is taxed at the new owner. So in this case, it would be the daughter. If the daughter's marginal tax rate is lower than the transfer's, the overall family tax burden may be lower, but it could be subject to kitty tax considerations. Watch out for gift tax problems. Additional administrative expenses, if any, should also be considered in this type of planning. Next, let's talk in regards of alimony for tax planning considerations. Under the prior law, tax alimony shifts taxable income from the payer to the payee. Under the current law, alimony payments are made from after-tax income. Okay? Let's talk about prepaid income. Lessors may want to collect the first month's rent plus a refundable deposit, rather than the first and last month's rent, to avoid prepaid income. So there's one good means of avoiding prepaid income if you're a lessor. There is a risk of recharacterization to income if the amount of the deposit is similar to the amount of 1 month's rent. Okay, so you got to be careful there. There is the risk of recharacterization of the income if you're setting that rate of the deposit the same as a 1 month's rent. Next, taxable, tax exempt, or tax deferred bonds. The taxpayer should compare after-tax yields when comparing among taxable, tax exempt, and tax deferred bonds. Reporting savings bond interest. So it may be a tax advantage to report interest from U.S. savings bonds owned by minor children on an annual income tax return. Now this is if the amount of interest is less than the standard deduction. Such annual reporting will result in no tax. This approach will avoid the bunching of income in the year of redemption. Okay, next, deferred compensation arrangements. So advanced contractual agreements to defer incomes, such as those common for professional athletes, are respected for tax purposes and are not treated under the constructive recipient rules or receipt rules. Next, let's talk just for a second on compliance and procedural considerations. Gross income is summarized on Form 1040, page 1. We saw that in an example from this chapter. From various supporting schedules, including Schedule B, which is interest and dividends, Schedule C, business income, Schedule D, capital gains, Schedule E, rents and royalties, Schedule F, farm income, and Form 4797, supplemental gains. Okay, once again, this is all for Chapter 3, dealing with gross income, in particular the inclusions of gross income. And then also we covered a little bit of tax planning strategies or tax planning considerations, and also compliance and procedural considerations. So I'll go ahead and post this lecture. Chapter 3 homework is available. You got plenty of time to do that. I think you have 10 days from now until it's due. So I think it's due on the 13th. That's Sunday the 13th at 11:59 p.m. So be on the lookout for that. Once again, it's describing how you tax Social Security benefits. So that's the homework, and I will be getting the quiz posted soon. Just want to point out that this weekend is Labor Day weekend. I have been posting these lectures a little later in the week. So my goal is, with this being a holiday weekend, my goal is to just catch back up and shoot Chapter 4 earlier in the week next week, and then try to stay on that schedule moving forward. So that's the goal. So be on the lookout for Chapter 4 stuff coming earlier next week and then later. That's my plan. If something would change, I'll keep you in the loop. But for now, my goal is to move it up. So I enjoyed having your time today. Once again, I'm always available if you need any help with anything. And good luck with your quiz and your homework. And I hope everything's going well with everyone this semester. Thank you.